Is Jim Walker, the founder and chief economist at Asianomics. It's a while since we spoke to Jim. Jim is, of course, a favorite for investment gurus and for investors. For 11 years in a row, Jim Walker has been voted the best regional economist in Asia itself. So, Jim, thank you very much for joining us. We have missed you a great deal in the past 2 years when you imposed your exile from the media. Thank you very much for joining in today.
It's a pleasure, Lata. Nice to be in India.
Well, thanks, Jim. Well, actually, you come perhaps at a time when the world economy is more joyous than it has been in the past several years. Would you think that 2017 is going to see the global economy slightly better off, growing better than it has in the past 3 or 4 years?
Well, it's possible it'll grow a bit better as long as certain people don't upset the apple cart too much. I mean, there's been a lot of money around for many, many years, and some of it is eventually going to seep into economic activity, and I think we've seen a bit of that over the course of the last 12 months. But actually much more important for producing certainly a bit of a revival in export growth has been a relatively weak dollar. At the beginning of 2016, the dollar was very strong, and then it weakened off right through the early part of the year, and that helped the dollar purchasing power in other parts of the world, which increased the demand for dollar-denominated exports, which is most of global trade. And that really was the thing that revived dollar fortunes, that along with the fact that China was doing a lot better than it had been in 2015. Will all of these things continue into 2017? As I say, it kind of depends on some of the personalities around just now.
Oh, yes, and that's exactly what we want you to analyze. Let's start with the United States itself. The stock markets are expecting big things, both on taxes and on growth. What's your sense? Will US show faster economic growth, or will this euphoria die down?
Well, as you say, there's a lot of euphoria, there's a lot of consumer confidence, and a lot of the confidence indices have picked up. But, you know, I've got to say that makes me slightly concerned, because confidence indices and signals on the business side are not always followed through into economic activity. And I think we really need to see whether that's going to happen. But here's my worry just now for the markets more than potentially the economy, that consumer prices have begun to pick up. Now, in our view, there's been plenty of inflation for the last 8 years. It's just been in money supply, and it's gone into asset prices. Central banks and policymakers are much more focused on consumer prices. I'm not quite sure why, but it means that they miss an awful lot of problems in the economy, but they are. And what that means is that as consumer prices begin to pick up, they'll be forced to tighten policy, even if economic growth is also accelerating. And here's the bad news for equity markets, and particularly the US equity market, in my view. Money supply growth will actually slow down. Consumer prices will pick up. Let's assume that economic growth picks up a little bit. And that means that there's much less money available to push asset prices higher. So what you could easily end up with this year is that economic growth is okay, consumer prices pick up a bit, central banks tighten, and stock markets come off 20%.
Oh, yes. That sounds a little scary at this juncture, Jim. But, well, there are two things on which the emerging markets worry, and perhaps even global markets. What we have seen actually is a strengthening dollar. It almost went up to 103, the DXY. And we saw US yields also go to 2.5. What's your sense about how those two factors might play out in 2017? And what might that mean to markets?
Yeah, that's what would worry me, Lata, that if we got a strengthening dollar, 103 or staying there, of course it's actually come off a bit since then, but let's say it went back to that or went to 105 and interest rates went up slightly, even just slightly from there. What that does is it squeezes purchasing power in dollar terms in places like Europe and Japan and the emerging markets. And that tends to be very bad news for export growth. So if that were to happen, then even though it's supposedly signalling a stronger US economy, what it would do is weaken the purchasing power of everybody else, and that would be a drag on exports for Asian countries, including India. And that wouldn't be very good news in terms of the attitude towards emerging markets. So, you know, what we really need to see is the dollar weakening from here. And to be quite honest, given the activity levels in the US, rather than the confidence indices, there's plenty of support for a weaker dollar. And I think that's what we'll see during the course of this year, as the interest rate rises that everybody's expecting actually don't come through.
Okay. Well, one spot of good news for emerging markets has been the rising commodity prices, not crude so much as metals. Do you think that trade can continue through 2017? We were pretty surprised by the metal trade in 2016.
Yeah, well, you know, at the beginning of 2016, we took off our short on commodities. It had been a very good short during the course of 2015, but we thought at the beginning of 2016 that it had run its course and that there really wasn't much downside to the commodity prices. And that was partly because there was already a supply response going on, especially in the metal side, and also a bit of a demand revival, not a strong one at that point in China, but at least a stabilisation. And that has continued, and in actual fact there has been at least some pickup in economic activity in China, along with reasonable economic activity in other emerging markets, which has been the case for the last 7 years. So the stabilisation in commodity prices came as no surprise to us. The fact they went up so much last year was a wee bit of a surprise. And I wouldn't be chasing that commodity trade now. I don't think there's much downside for commodity prices, but I think there's very limited upside now. So I'm happy that they've revived, and I think that's good news for emerging markets generally. But I don't think that there's going to be much more in the way of upside surprises from commodity prices this year.
Well, one more global factor before I ask you your India views. China gave us a lot of nasty surprises in 2015, and even in early 2016, we were all worrying about yuan devaluation. But actually, 2016, China was a benign factor. What will China mean to the global economy in 2017? More growth, more commodity purchases, or some instability which we are not able to put our finger on now?
No, I don't think we're going to get very much in the way of instability in China this year. I think there will be a continued stimulus push. China has been very interesting in the course of the last 12 months in that it has replaced foreign reserves as the driver of money supply in the Chinese economy with domestic corporations increasing the money supply. So the central bank has shifted the emphasis. Effectively, they've done something of a QE within China. And I think that's going to continue. It's specifically going to continue this year because this year's an election year in China every bit as much as it's an election year in France and Germany. And Xi Jinping, the president of China, fully intends to have the support of the National People's Congress when they meet in October to get another 5-year term. So I think it's pretty well steady as we go in China this year, maybe a little bit more stimulus, not dramatic, and the economy is going to be doing just fine.